All right, we're going to get started here in a couple minutes. Just waiting for people to enter into the room here. And just love to see maybe what your biggest pain point is on the accounting side currently in the chat. Also, where's everybody from? So yeah, we're going to get started in a couple minutes. Yeah, good afternoon, everyone. Hey, everybody. So we're seeing, wow, everyone really kind of scattered throughout the country here. I did see, like I said, also would like to kind of see what the biggest pain point is on the accounting side too, as we wait a couple more minutes for people to filter in. I see accounts receivable. That's definitely something we're going to be touching on today for sure.
Hey, everybody.
See a lot of familiar names. Hope everyone's doing well here. Yeah. I know accounting is not the most exciting thing, but definitely think you all will have a leg up here. Just knowing a lot of this stuff. So super excited.
I see Scott is from Long Island. That's cool. We're in Long Island as well. We're in Hauppauge. It's in the middle of the island.
Scott's in Manorville, I believe.
Oh.
Yeah.
Okay. We'll stop.
Managing cash flow during the off season and during the busy time. That's a big thing as well. All right, we got it. We got Alaska. Very cool. I wonder if Jesse's here. I know he's up there as well. Also see biggest accounting pain is some of the materials and plans that they're selling to the customers. Okay. No, thanks everyone for mentioning the comments there. Again, we're just going to wait another minute or so. Want to be respectful of everyone's time as well here. Hey, Mark. Nice to see you. Nick, a lot of people as well. All right. All right, so we'll get started here. This this webinar, New Year, New Plan, Setting the Accounting Foundation for Your Green Industry Business. My name's Joe with Cycle CPA, co-founder along here with Carla here. And also we have Aaron. So Aaron's one of our superstar supervisors here at Cycle. And, he put a lot of this stuff together here as well. And, really, like I said, looking forward to kind of diving in here.
Yeah, thanks for joining us, Aaron.
Good afternoon, everybody.
So we can kind of cover some of the things that we're going to go through today. I think as you're kind of thinking about this year, there's a lot of those bigger items and different changes that you're looking to make. We wanted to cover in this webinar on the accounting and financial side some of the things that maybe are worth changing or looking into in regard to your setup. So looking at the processes and structures, bookkeeping, month-end close, right? Both expense and revenue management. I know someone said it, accounts receivable, right? That's always a big thing, making sure that you're staying on top of collections. But then also the accounts payable. I think that's a less talked about thing. And some of you may also have that pain point currently. Payroll management, job costing, project profitability, right? We know there's a lot of great operational softwares out there that help with that, right? But how can your accounting team and your setup help facilitate that as well? Service line and location tracking, compliance, not the most exciting thing, right? But you want to make sure to stay on top of that. Cash flow and risk management. Again, I know that was something that was brought up. Internal controls, and financial reporting. So, and then the accounting process and structure, right? So looking at, and you can look at a lot of aspects of your company in a similar way too, but what aspects, especially based on your internal strengths as the owner, or even when you look at your management team or your administrative team or operations team, what things are you good at or capable of handling, and what items are more worth it to have others handle and almost leverage their expertise? And that's how we look at this a lot, especially on the accounting side. And when you look at some of those positions, I know, for instance, a very common setup we have with companies that are into the 7-figure range is, you have that administrative help, right? But you need maybe someone to handle that month-end close and more of the advisory meeting perspective, right? So it's kind of filling those gaps, So, and then also taking advantage of a lot of the cloud-based accounting applications, right? Whether it's accounting or payroll softwares, right? There's a lot of options, especially when it comes to syncing or integrating within those different softwares. And a lot of you are great at developing systems, and there's even training platforms where you can create videos for crews and different things like that, that perform the work on the projects. But think of that also on the administrative basis. Okay, what are some checklists and things we can put into place, which we're going to go a lot into as well. And then what accounting roles do you need, right? So a smaller company, you kind of need to fulfill all of these roles, even though you can't necessarily hire a single person in each, right? And that's why we always recommend trying to utilize part-time help, subcontracted help, outsourced help, right? To kind of fill whatever voids you currently have. So whether it's a bookkeeper and recording some transactions, payroll specialist, helping to process payroll, AR and AP clerks, right? Keeping up with that side of things. Staff accountant, do you have someone that can handle journal entries, that has that accounting mind, that you feel confident you can send, or you can then actually have this data to make decisions off of? Accounting manager, right? Someone to kind of put it all together. A controller, someone that sets up internal controls, that helps to lead the accounting department as well. And then the CFO, someone that's more forward-looking, right? Someone that can have more of those strategic conversations as well. So trying to fulfill some of these needs, like I said, no matter what size company you're at.
Yeah, and these next couple slides we'll look at, this talks through really kind of the foundation of what generates the financial statements, which is then used to make decisions. And so looking at the bookkeeping and month-end process, we'll kind of break this down a couple of different ways. So the first thing we'll look at is the chart of accounts. And the chart of accounts is really where the initial data, if you will, from the bank account, where it flows into your accounting software, where it gets captured. So as you know, looking at your balance sheet, looking at your profit and loss, income statement, variety of different accounts there. And so just with the chart of accounts, something to just kind of keep in mind, consider is reducing overlap. And also when you look at a financial, just making sure it's easy to read, it's easy to follow along with, and that you're able to really, unpack and understand what it is that is on there. And so just having everything organized, having all the different types of income or inflows to the business, just keeping those, segregated in their correct spots, and making sure direct cost and the costs that go into producing the revenues, making sure that those are consistent and they're easily comparable year to year, so you can really understand how you're growing, and even if revenue stays the same, if you're more efficient year to year in producing those same revenues. So just definitely something to look at. And then the last bullet point there, mostly balance sheet driven as a note, but as you grow, you're going to have more vehicles, most likely, that you'll be purchasing, and have more needs equipment wise as well. And so over time, this is just maybe more of a way to kind of reduce some of that length, and just making sure that the financials are easily digestible for those who are going to be involved in reviewing them.
And we are sharing right now. I just shared the Green Industry Chart of Accounts with everyone as well, so you can download that as well.
All right. And so on this slide, we've got this kind of broken up into two parts: bookkeeping on the left, and then the reconciliations on the right. And so, as you know, with bookkeeping, this is going to be the recording of the transactions and where they get bucketed each week, each month. And so some of the suggestions that we have is syncing your accounting software to your bank account allows for those transactions to just flow in naturally. And in doing so, we also can leverage, in the case of QuickBooks, different things like rules to help streamline and make sure that we are accurately and consistently coding transactions to the right place. And then for those of you who may even be tracking by location or different divisions, so if you offer a mix of services and we kind of bifurcate those separately, then the bookkeeping is really important, so we can understand which ones are profitable and how we're doing year to year with those. Reconciliations. So while we do encourage, again, the sync of a business account to the software, we still want to go ahead and reconcile it as well, making sure that all of our transactions are accounted for. We don't have anything that's maybe duplicated and maybe overstating expenses or overstating, cash on hand, those kinds of things. And likewise with the loans, we also want to look to reconcile those each month as well, break out principal and interest when we make those payments. And just, a couple times a year, maybe take a look at the balances and make sure that we are, truing those up, so we are reflecting at any point accurate loan balances.
Yeah, and something I wanted to add, I see a lot of you asking about cash flow and a cash flow plan and stuff like this. And where it begins truly is with the data that your accounting software holds, because maybe you're looking at your bank account balance to make decisions based upon cash flow, but your bank account tells you the balance in it today as of right now, right? It's not telling you anything forward looking or historical. It's giving you a snapshot of today. But if you do your bookkeeping, you reconcile your accounts, like Aaron said, you reconcile loans, then we can come up with a cash flow plan, because now we can look at what is called the balance sheet, calculate some ratios, and we're able to forecast data in that way. We're able to monitor trends, such as how were you doing last January? what was the financial situation last January in your P&L and stuff like that. And then we could better predict what's going to happen in the future. But if we don't have this data in your accounting system, then you're going to be very limited on what you can forecast and plan for. And that's all we try to do in business, is try to make good business decisions and have a plan for your cash and stuff like that. But we can't do that without setting down the foundation first.
And yeah, so on this one, this is just kind of a screenshot from QuickBooks, from a journal entry. And so when we are reconciling loans, what this snapshot shows is how a loan would be posted. So getting into debits and credits, asset account, well, we're going to put a nice debit there and book the asset onto the books. And then as we are making payments, row 3 there, that notes payable, that line on your balance sheet should decrease with each monthly payment. And then, so regarding assets, so we like to look at fixed assets every month if we can, and look for anything that may be coded to an asset account, and just understand if it's something we are going to book. At a minimum, we'd really encourage, just taking a look every quarter at least, and making sure that if there is anything purchased or sold even, that we have accurately captured it, or it has been captured, within your balance sheet, and it's reflective of that. Depending on assets we have, that's going to drive things like depreciation expense. It allows us to, if we do, if you're doing tax planning with your tax preparer, if they're able to look at the types of assets you've purchased throughout the year and see what, how they may benefit you from a tax perspective, that's always a consideration. And then for those of you who we may currently already serve and work with, if we are meeting with you, you've probably already seen our CycleScape reporting, and we can kind of help unpack a little bit of the asset usage and kind of return you're getting on your fixed assets. And this is really important because it can help us understand if there's underutilized assets, if there's idle assets, if we have extra trucks or equipment that may not be fully utilized, and then kind of game planning how to get them to that point, if it makes sense to offer some services, or just being creative with how to use those. And then along that same breadth of cash flow and kind of forecasting and kind of looking more outward into the future, really understanding current asset usage, current financing and whatnot, it allows you to really kind of help plan for the future, what you may or may not need down the road, and how to plan for those things, especially if you get into maybe needing down payments for vehicles, or what does your month-to-month finances look like, how much can you afford if you do need a piece of equipment, that kind of thing. So kind of takes the here and now and what we know is call it current state, and really trying to do our best to create that future state based on what information we have at the time. So, and then just a couple other things, again, more forward thinking, but just when we come to that fork in the road, if you will, and we have a couple pieces of equipment, trucks, vehicles that may need repaired or replaced at some point, again, this can really help us pin down the information that we may need for that.
Thanks, Aaron. And yeah, we also, as a handout, 10 questions to ask before we purchase an asset. So I just shared that, so you guys should be able to download that as well. Just something to think about when you're making those kind of decisions.
And then, so some of these screenshots that we see here. So looking at the blue one here, recording an asset. So this is, again, a snapshot of a journal entry of how a finance vehicle may be recorded within your QuickBooks account. The truck 1 and row 1 represents the asset that's being capitalized, and then the line 2 is going to be the loan liability that is being captured in your liability section. The orange represents, example journal entry of a depreciation entry. So based on number of assets, type of assets, that'll drive your depreciation each month from a book perspective. And if you look to the right of that, those little bullet points, there's an example of what that may look like. And then on your balance sheet, excuse me, on the balance sheet, you'll also have the, and this is going to be the bottom left, light blue. Again, snapshot of what that may look like on the balance sheet, and then likewise on the right-hand side, the P&L, where the depreciation line item may fall on your income statement.
Yeah, and just for those who don't know what depreciation is, so it is the annual expense that you're going to take for the wear and tear of a big purchase that you made, like a truck, right? I buy a $30,000 truck, and what we say is I'm not going to expense the whole $30,000 in year one. Like if I purchased a $30,000 truck today, I'm not going to put the whole $30,000 on my profit and loss today. And the reason why is because I'm not using it all, the truck today. Like it's going to be in use for, let's say, 5 years, right? That's the general rule of thumb for 5 years. If I use a pencil, right, I might expense this today because it's probably not going to be here next year. Obviously, I'm going to just expense it all in 1 year. But a truck is not like that. That your business, think about it this way, your business is benefiting from that truck for the next few years. So it doesn't make sense to expense it all in 1 year. Now, your tax accountant may expense it all in 1 year so that your tax situation is a little bit more advantageous or something like that. That's fine. That's what the tax accountant is going to do. But for book purposes, we want to expense it on a straight line basis over the years. And this is exactly what we do and what we help to do with our clients, because we want to make sure that we're passing this expense through to your clients. So if you're building an estimate, you want to pass this expense through that you're using, these trucks, these bobcats, skid steers to your client. That's why this is important. And this is the biggest thing that I see that's missing in overhead costs that are not getting captured, which if you tell me, that's a lot of money that I'm losing out, right? So very, very important that you have depreciation, but make sure it's not tax depreciation. It's book depreciation. All right, so next, a frequently asked question that I get is, should I buy a new piece of equipment or a used piece of equipment? And here I put a little scenario on the left and on the right. So you can see that the used piece of equipment, the total cost ends up being $59,000, but for the new, it ends up being $48,000. The new piece of equipment costs less because it requires less repairs and maintenance over the years. So, I'm only going to spend $5,000 versus on a used piece of equipment, I'm going to spend $14,000 because it keeps breaking down on me. I need to buy new, updated, widgets, whatever it is for the piece of equipment. I need to train my people on how to repair this if I don't have a mechanic, things like that. Downtime. Now, what is downtime? That means that maybe I wasn't able to complete the project as quickly as I could, right? That's efficiency. And I'm paying my workers hourly, to be out there working on a project. If something breaks down on me, sometimes as business owner, we don't see that as an expense, but it's an expense, right? By the time I go and I drive to the mechanic and I explain the situation, how much money am I worth? Is my time worth, right? I have to drop it off. That's 2 hours. I have to go pick it up. And there's a certain opportunity cost to it as well, right? If I am spending my time talking with the mechanic, going to pick this up, that could have been time that I'm spending on selling a new job, managing a project better. So there's a certain opportunity cost, right? And obviously, I'm not telling you, for every single piece of equipment, you have to get a new one. No, but sometimes it is advantageous to get a new piece of equipment because it's going to cost less over the year, especially if it's something that I'm going to use every single day. Like if I'm a maintenance company and I'm going to use mowers every day or for most of the time that I'm in operation, then I want to get new, good, mowers that I can rely on.
Awesome. And I do see some questions relating to this topic. What is the number? So Glenn asked, what is the number you use to determine if something should be reported as an asset?
2,500.
Okay. And how do you determine the number of years to depreciate the asset? Alex.
So we go standardized, like by what the IRS says. So typically the general rule of thumb is truck 5 years, and then machinery and equipment 7.
Okay. Does that change on a book or tax basis, Carl?
Well, that is book basis. Tax, like I said, it could be accelerated, depreciated over lesser years than that. So.
And Carlos asks, what's the amount you use for depreciation? Is it the full amount you pay for the asset or just the premium paid?
It's the full amount paid for the asset, the cost of the asset. Yeah.
Okay. All right. Awesome. And then Julie, your question in regard to depreciation, this kind of shows it, versus the lease option.
Awesome. Okay, so I put together this example to kind of break it down for you guys in a simplified way. Let me walk you through it. So this is the situation. So maybe you're looking to buy or lease a piece of equipment, a truck. So let's say that the truck value is $40,000, and the net profit of the company over a 5-year period was $500,000. For 5 years, I generated $500,000 net income cumulatively. So the initial down payment that I have to make for buying a new piece of equipment is $4,000 versus leasing is just $1,000. Okay. Obviously, buying is going to have a bigger down payment associated with it, right? All right. So that's a bigger outlay out front. The annual payments for financing, let's say I'm paying $7,200, but now when I buy, my loan associated, right? It looks like 6% interest, right? That I'm paying on that loan. So, like Aaron mentioned earlier, you have loans, you have to reconcile your loans. Loans have interest associated with, which becomes an interest expense. That's on your P&L. Now, when something becomes an expense on my profit and loss, that means I'm going to have, that's going to lower my net income. That means I'm going to have some tax savings associated with that. Does that make sense? Versus lease payments, $8,000 per year that I spend, that is deductible as a lease expense on the profit and loss as well. So on one side, I have my interest. On the other side, I have my entire lease payment. Then we get into depreciation. When I buy an asset, remember, I can take depreciation every year from a tax perspective, which would be around, $40,000 for the 5 years, which comes out to $8,000 a year for 5 years, versus a lease payment. I can't appreciate that because I can't call that my own or the company's. Something that the company owns, I can't depreciate, right? Because it's leased, somebody else owns it. So only the lease payment gets deducted. So now I have another tax savings, with the depreciation, with buying it. The next line is interest expense, which I already talked with you guys about. Because I'm taking out a loan against that asset, I get to deduct the interest, whereas a lease option I can't, because there's no loan, it's just a lease payment. Then obviously there's probably going to be some maintenance and repairs with the buy option, so that's going to be $5,000. And lease, you're probably going to have less maintenance and repairs, because usually it's partially covered by the vendor that you are doing business with, right? They're probably going to cover some of those repairs and maintenance. And then residual value. What that means is, if I want to sell this truck in the future when I'm done with it, can I get something for the truck? So right now I'm estimating that for this truck, at the end of 5 years, I can probably resell it for $14,000, right? But for the lease, I can't resell this because it's not mine. I don't own it. So I'm not going to be able to resell it. So the total cost over the 5 years for the buy option comes out to $16,000 after all of those expenses are taken into account. So what I did is the $40,000 purchase, right? You add the maintenance cost, which is $5,000. So that's $45,000. You subtract the $12,000 that you get in depreciation, the $3,000 interest, the $14,000 in resale value, and that leaves me with its total cost of $16,000 that nets over the 5 year period. Versus lease, I have $40,000 in lease payments, $2,500 in maintenance, minus $8,000 in tax savings. It comes out to $34,500. So I don't know. In this scenario, I would go with the buy option. It's only going to cost me $16,000, right? So, but again, it depends on your circumstance in your business, right? And so this is an easy way to kind of break it down and make a decision based on that.
All right. So this slide is going to go through, hit on some bullet points for expense management. And so one of the things that we hear often is, where can I cut back as we're going into the winter? What are some of the higher expense items, things I should look at? What kind of goals should I set for this year from an expense perspective? And so really, one thing that we've found and would encourage is, creating a budget for the year. And this can be developed just through looking at, the prior year's numbers and just seeing where certain expenses, were, what the totals were for the year, and then track against that on a monthly basis. But having some sort of expense management process can be super helpful, especially making sure that there's not a lot of, that there's, any kind of expenses are, quote unquote authorized for use, for business use. And then if you are doing a receipt collection process, just, ensuring that those are being on time, submitted and captured. Again, kind of along the lines of class tracking and divisional tracking, if receipts are being provided, or just expenses in general that are being captured, just understanding if those, what division those are attributable to, and making sure that they're allocated correctly. So if you do run, kind of looking at the income statement by certain divisions and classes, that we have a good picture of what that looks like, as long as those expenses are correctly captured. And then just, with a regular review of expenses, it can help, really find maybe a software or a subscription or something like that maybe isn't used, or it's not used enough to maybe warrant keeping it. And so just doing that can also help clear up some of those one-off items. And then from the standpoint of vendor relationships, suppliers, and things like that, if you have a good idea of what you've historically spent with them, it might give you an opportunity to go to that vendor and say, hey, I have, last 2 years I've spent, for example, $100,000 with you, but love an opportunity to keep the business up and maybe, you're able to negotiate some terms, and maybe get some like flexibility with payments, so like net 30 terms, net 45, that kind of thing. And in doing so, it can position you to have a little bit more flexibility with when you pay those invoices. So from the standpoint of cash flow and liquidity and having enough cash on hand, can help you kind of, have some flexibility with those.
Joe, I think you're saying
Oh, I'm
something, but
sorry.
you're on mute.
Yeah. So Ruby had a question. Does the vehicle or equipment need to be under the business name?
Generally, yes, but it doesn't have to. I see this with sole proprietors a lot. When you first are in business, probably hard to get qualified with under your business because, banks, you use the last 2 years of tax returns to kind of look at financing options, stuff like that. It's perfectly okay to have it under your personal, but you need to have proof and backup that you're using it for business expense, as a business. So, if you're using it for projects, for estimating, things like that, and you can prove that very clearly in your daily operations and what you do, there's no problem if you have that under your personal, kind of expected with sole proprietors, businesses that are just starting up that can't qualify under the business name.
Awesome. And Julie had a question. What is the average industry expense to sales ratio we should be striving for? So the industry average is closer to, in regard to total expenses, so that's total direct and overhead expenses, that could be closer to around 94% because the average profit is around 6%. Now, that's very different than what your goal should be. Your goal should be closer to around 15% net profit. So.
All right. And then for revenue management, so I think a good takeaway from here is, in the same breadth of cash flow and what that looks like, with having contracts for the types of work that you'll do, whether it's going to be maintenance work and some of the more recurring services, if it's going to be something that's maybe more construction based where, you have maybe a little bit more material heavy, those kinds of things. We definitely encourage having payment schedules and having contracts where the customer, your customer, understands what their obligations are and at what stage of the project justifies the progress bill if you are doing progress billings and those kinds of things. And this really helps smooth over the need for the materials to do the job. If you do have employees, you may also have to pay them a pay period or two in between, while that project is going on, depending on the size of it. And so it helps to not have to float some of those expenses for a week or two or more in between getting payment from initial start to the end to the finish line. So, some of the ways that can be mitigated is through having a credit card on file, having bank information on file so you can do an ACH withdrawal. We just encourage maybe giving customer a heads up so they can be expecting it. And then with like CRMs and invoicing systems, again, if you are doing class tracking, divisional tracking, just ensuring that those are updated so that those revenues sit in the right bucket that they should. And one example we dropped in here was, we see a lot with QuickBooks invoices. You have the option to select a product or a service, and there's something that's called a mapping. And what that does is whenever that product or service is selected, it automatically maps to a certain revenue account. And so if it's, like a paver, for example, that might be more of a construction-based project where a paver would be used. And so if you select paver, we just want to make sure that it goes into the income account where your construction-based revenues are captured. So. All right. And then accounts receivable. So first thing we definitely suggest is, development of some sort of AR procedure. And again, for the recurring type of work, that could be maintenance, mowing, those kinds of things, where you're already on a schedule. If you are, for example, going to bill on, February 1st for the work that you're going to do in the month of February, just establishing that. And that could also be part of the contract, is that the first of every month we will charge the credit card on file for the work that we're going to do this upcoming month, and that way it helps with cash flow and not having to go after invoices and have a larger AR balance. Also to leverage technology. A lot of CRMs nowadays, they will allow you to have automated reminders so that a week or so, a few days before an invoice becomes due, it does send out an email or a text perhaps to your customer so that they know that they have something coming due. And then also whenever those invoices are on the due date, or even when they go past the due date, you can have those systems in place within a software where it automatically reaches out to the client as a reminder. And then the last bullet point here, just in terms of communicating with customers, you can use a variety of items here. You can do phone calls, text messages, emails, even a site visit, those kinds of things. But just really refining the process so that cash can be smoothed month over month.
Awesome. And I know there's been quite a few questions in the chat, but just wanted to do a quick reminder as we're going through the slides here. If we don't cover it now, we'll cover it at the end, but definitely, please put your questions here. That's the nice thing about being live here. We can, run through any of those main questions you have. So.
And so on the flip side of accounts receivable, money that people owe us, we have accounts payable, people who we owe. And so similar under the same breadth of receivables, a good procedure for accounts payable, consider whether it's going to be through QuickBooks, tracking it. There's also a platform, Bill.com. It's really an all-in-one solution. It captures all the invoices. It's a very robust system. And so it's kind of a one-stop shop to really own the entire accounts payable process. And then just with different ways to, pay, it could be through checks, it could be through credit cards. Bill.com is one of those, so you have a lot of flexibility with how you want to pay those things. But just some general tips, having some sort of centralized method, whether it be a shared email, it could be a spreadsheet, it could be a software such as Bill or something else. But really just consolidating that and keeping the invoicing component of the business to just a centralized area, and maybe having somebody, if you are at a size where you do have someone helping on that function, just really, taking that ownership and with them and letting them own that process. Something too is when you do work with new vendors, subcontractors, suppliers, it's a really great time to really set the expectations on terms. So what their expectation is of when to be paid, what your needs are, and hoping to find the middle ground in between the two. And sometimes there may be times, depending on the seasonality, where not all invoices are paid on time. And if that ever does occur, just encourage good communication. A lot of times, those who work within our industry and just in any other industry understand that there may be seasonalities that are at play. And so we found that the best thing is just an open door of communication, can really help, keep the relationship alive and allow for some flexibility.
Yeah. Like I said, AP is not talked about a lot, but I think making sure to balance that with your ARs.
Yeah. And again, like with a lot of you being concerned about cash flow and stuff like this, being strategic with the AR and AP and everything that Aaron just went over, the tips and tricks, that could make a huge difference in your cash flow and how you're managing your cash flow. Let's say that I'm a maintenance company, and like Aaron said, on February 1st, or, February, unless you're in a consistent, in a different climate. But let's say that, March 1st, I'm billing for March services, right? For the work I'm going to do in March. So it's kind of like prepaid, right? And I'm auto drafting it from my client's accounts, March 1st, right? Now, my employees, I'm going to pay them later during the month in March, right? So I'm putting myself in a good position because I have that cash inflow into my account March 1st. And my payroll doesn't hit until, whether it's biweekly or weekly, right? So from a cash flow perspective, I'm putting myself in a good position because I'm collecting the money first, then the money's coming out. Now, like Aaron said, establishing vendor terms and using that to your advantage. If I have a trade credit set up with Site One, I go and pick up the materials today for an install job that I'm doing. If I don't have to pay for those materials because I have a credit terms with the vendor set up, if I have 30-day terms, I don't have to pay it until February 23rd, but I get the money down, like 50% down for my client today. I'm putting myself in a good cash flow position because I received 50% of the payment today, but I don't even have to pay the materials until 30 days from now. So I want you guys to have like that mindset when it comes to cash flow and that strategic thinking. And that's really what we mean by managing AR and managing AP. You always want to put yourself in a position where you're receiving some or all of the money first and delaying the expenses as much as possible. I'm not saying don't pay your vendors because we don't want that situation, but you know what, in this industry, what I've seen happen is that all of you are such like nice people, honest people. What I see is you guys pay your vendors faster than you get paid. And you work so hard. And that's what I see all the time in the books. And it's like, wait, these numbers should be, inverse. You want to get paid first, then pay your vendors, And so many times I see that we're paying vendors too quickly before we receive payment on our end, So I hope that makes sense.
Joe, I think you might be on mute.
Oh, I'm sorry. So Julie had a question. She said, we are assessing if we should establish a client loyalty program, especially for our maintenance clients. So I'd be curious if anyone else here provides a client loyalty program. So please, if you do, love to hear your thoughts. And she says, do you have any recommended approach to try and figure out if we should do it and how we assign rewards based on the service level by client? So Julie, I would say just what is the end goal with that? Running the numbers and basing it off of maybe the longevity that the specific client is with you, also the actual revenue size as well, and trying to design a program along that would probably be a good start. But like I said, I'd be curious if anyone else here has ever tried something like that. And again, Julie, if you can kind of give an idea of, I guess, what your goal is with that. Is it customer retention? Is that really what's driving that? Or and then payroll. So we like Gusto. I mean, that's what we even use within our firm to run payroll. That's but we work with any other main payroll providers as well. So I'll let Aaron take it away here.
No, thanks, Joe. Yeah, and between you'll see the first bullet point, Gusto, ADP, and Paychex. I would say three of some common ones that we see often. There's others, NetChecks, and a variety of providers out there. One of the nice things about just the three of that we have mentioned here is that some sync really well to QuickBooks and have an interface that's very nice to use. And one of the really nice things about a provider is that they handle a lot of the compliance work. So like the 941s, which these are going to be your quarterly reports that have to be filed, essentially. And they pretty much take over the entire aspect of that part. So it kind of takes a big lift off the plate. If you do decide to pursue something, a 401k that's set up, different types of IRA plans that are out there, health insurance, a lot of times those also have partners that they could do. And so it's nice to get connected to a payroll management company, because then they could pretty much be your partner throughout all of those things related to that. So that being said, we definitely suggest things like direct deposit if that's an option, running payroll regularly, and to the extent we can, avoiding any off-cycle payroll runs, or one thing we see is bonus payments and any kind of other types of payments that don't go through payroll that perhaps should. And so just from a compliance perspective and whatnot, just leveraging the payroll software is best practice. And one thing to suggest too is for those who may have someone that does payroll currently for you, having a second set of eyes. So maybe someone, whether it's you as the owner of the company or someone else, depending on company structure, someone who's not involved in the normal process be the one to do the review, just to ensure things look as they should.
Awesome. And another thing in regards to payroll providers, I think there's a lot of HR capabilities built in, even just with the onboarding of employees. So that's also a great perk too. And moving on to another topic. So when it comes to job costing and project profitability, it's good at the end of the month to be able to look at your financials once everything is reconciled, right? Because that's really what it all comes down to at the end of the day. But it's good to have an even quicker feedback loop in regard to just the profitability for each job as well, right? It allows you to make quick adjustments based on what you're seeing with that data. Then it allows you to then improve the pricing and making sure that you're marking things up in the correct way, leading to higher profits and cash flow, because ultimately, yes, if you're not doing stuff like this, you might get lucky here and there, you might make higher profits, but you're also more likely to kind of hit those valleys where, cash flow might be an issue because you're not as in tune with some of the profitability of each project. Almost look at it as if, job costing is like small profit and loss statements, right? That pretty much accumulate into that P&L.
Yeah, one of the things that an accurate job costing reports has the elements. So I like to break it down to 3 simple things. So your direct job costs, right? Items that can directly be traced back to the job, which is materials, and your salaries and wages for your workers working on it. So that's one. And then So for number 1, I should have said the revenue, obviously the revenue that you're generating for that job. 2, the direct costs. And 3, the overhead allocation, right? And then those elements make up a complete job cost report. And you'll be able to see your net income, because if any of those 3 are missing, then you don't have a job cost report. And here we have service line and location tracking. So kind of on the same lines along the job costing. So you may provide different services, maintenance, install, irrigation work, tree work, right? And you want to track your profitability for each division that you're managing. So you can use the class tracking function in QuickBooks to differentiate all the transactions into specific buckets. So if a material, if you went to like Home Depot and that went through on your QuickBooks, and I know that transaction dealt with a maintenance client, then I can categorize that as maintenance, and so on and so forth. But then, like, here are the three elements: direct labor, direct cost, and overhead allocation. Same thing for a profit and loss statement by division. I need to allocate overhead to each division. So that's where a lot of people get stuck, is allocating overhead to the specific job and to the division. And that could be done via a journal entry, is what it's called. So if you need help with this or anything like that, we can definitely get that set up for you on job costing and divisional tracking as well. And then somebody just asked, does QuickBooks have job costing abilities? And yes, it does. Yep.
And we have videos on our YouTube channel that go through actually some of the QuickBooks versions of this too. So it gets into a little bit more of the specifics with that.
Okay. Now, compliance. So, this is some of the stuff that you want to make sure you're keeping up with so that we don't get in trouble with, the IRS or state, different things like that. So just wanted to put this on your radar. Make sure you have accurate record keeping, just in case you get an audit with the IRS, you have receipts for the past 7 years. And now those could be digital receipts. It doesn't have to be physical, but if you have physical, that's fine too. Make sure you're compliant with sales tax. If you need to file sales tax in your state for the services that you provide, make sure that each state website has a special page where you can go under landscaping services and seeing if you do need to file sales tax. And if you do, that either needs to be filed monthly, quarterly, biannual, or annual. Worker classification. When you run payroll, make sure that you're running payroll for people that, you would classify as an employee and not a subcontractor, right? Vice versa. Because an employee, that means that they're under your control. You kind of are controlling the time, the equipment, how the scope of the job and how they're going about that. Versus a subcontractor, you have no control over the time, the equipment is not yours, then that would be a contractor, right? So making sure you're making a clear distinction on that. Payroll tax. So we've seen a lot of people get in trouble with this. Making sure that you're paying the federal government the payroll taxes that are withheld, because this could get you in a lot of trouble and add up to a lot of fines and fees. Making sure that, I know we were talking with the team the other day, that for whatever reason on QuickBooks Online, one of the business owners didn't realize that QuickBooks wasn't filing payroll taxes because they weren't opted in for that or something. And now they have to file back taxes. And now, there's a lot of fees and penalties incurred through that. So deductible expenses, just making sure that all of your expenses are truly business expenses and not personal. It's not mixed into there. Making sure you're up to date and compliant with tax laws. And of course, your business tax filings, making sure that you're, it's tax time right now, making sure you're filing on time, and making your quarterly estimated payments if that's required for your business as well.
So discussing cash flow, hopefully this will help answer some of the questions that we've been getting. So we think that good practice for cash flow and just monitoring it is just to have a weekly check-in. This could be something that you build out in a spreadsheet with your list of upcoming expenditures for the week, phone payments, and those kinds of things. Going back to accounts receivable, just making sure that there's a process in place, and this is part of that development of procedures of how those aging account balances are going to be, how we'll reach out to them and what the collection process will look like. And so in doing so, sometimes we've seen where a business may have different agings across, some may be 60 days old, maybe 90 days old, some may be just a couple of days old. And so when you're already kind of operating without those older invoices having been paid to you yet, sometimes it can be a nice kind of almost like a bonus, right? It's money you already owed, but it can kind of help with some of that cash flow week to week. And then with the accounts payable conversation, just again, utilizing those vendor payment terms, our goal is to get our cash quicker and pay it within reason later. It's still within terms, but we want to hold on to our cash a little bit longer. And then the parameters for when invoices are being paid, this is really part of that procedure of approvals, making sure that there's a couple of layers, duties are segregated so that there's a checks and balance kind of at place for any kind of cash movements. And then with cash on hand, we've seen profit first. We've heard a lot of about that, and maybe it makes sense to segregate some funds for different purposes. That may be payroll related. It could be sales tax, savings, job deposits. So we're using those funds to pay expenses toward those jobs. And so there's a couple of different strategies one could use when it comes to cash management. And then again, just looking at both AR and AP, seeing how those two marry up, and whenever there's larger dollar decisions that have to be made, just really taking stock of, where we are currently and what maybe the next couple of weeks are going to look like as well. And then last item here, it says avoid excessive inventory. And so, do recognize that a lot of suppliers will offer discounts for bulk pricing. And we definitely think that that's, definitely an opportunity to save some money. But just maybe not, if there's things that we don't use very often, maybe just not buying those kinds of things in bulk, or at least, judgment on the seasonality of the business. And so that way we're not tying up a bunch of cash that may not be convertible, immediately. So.
Awesome. And just to kind of continue on with that, when you're looking at both the cash flow and from a risk perspective, so looking at one of the ratios, liabilities to assets, basically, and I say this a lot, but if you almost look at it like your liabilities is a mortgage for a home, and your assets is the home value. If a bank were to be looking at it and the mortgage made up 97%, then it would be a bigger risk for the bank, right? So the average in 2024 for the green industry, when it came to the median, actually was around 0.6. Then even looking at net cash flow, right? So net profit was closer to around 6%, but your net cash flow, because of a lot of those balance sheet items, loan payments, asset purchases, is actually closer around 0% for the industry median. So again, that's why it's important to make a healthy net profit, because there are some of those other back end items that affect cash flow as well. And then the current ratio. So really looking at everything that you owe or that when it comes to like current assets, so that you own in the short term, like cash and different things like that, and then you look at that versus what you owe in the short term. So you can see the green industry median was 1.87 to 1. So that's a pretty healthy place to be.
Segregate internal controls are something that a lot of business owners don't pay attention to. in every industry, to be honest. I worked in auditing for a few years in public accounting, and even Fortune 500 companies didn't have this down sometimes with their processes. But it's important because fraud, mistakes, errors, people that work in your business, sometimes things do go south because some of these items are not in place, right? And, unfortunately, we have run, through a couple of situations where certain internal controls were not put in place internally, and we've seen the repercussions of that. So I just wanted to highlight this today because, again, it's not really brought up as a topic anywhere. But segregation of duties, separate tasks, like approving transactions and reconciling accounts to prevent fraud. I would say for bills, the invoice approval process, whoever is setting up the bill, entering in the bill that's going to be paid is not the same person that pays it. Because if you think about it, if I have full authority to set up a bill and I can pay it, I can set up dummy bills and get it wired to my account if I really wanted to do that, right? And it has happened in the past, and it could be small amounts. But what happens is that a lot of small businesses don't have resources, time, and money to allocate to this. So a good workaround is if you do have someone that's going to enter the bills and pay them, you can have an approval process in place. So what we would do in Cycle is I enter the bill, then it goes to the client, to you, and you approve it, and then we pay. So making sure that you have an approval process built in if you're having an outside party pay your bills, right? Same thing goes with payroll. The same person that runs payroll, right, that's entering that shouldn't be reconciling your accounts, right? Because then there's no safety guard against any payroll fraudulent situation that may be going on, if that makes sense. So, and all of that, having strong passwords in your banking, things like that, making sure you review your financial statements, having approval processes in place. And another thing is data backup and security.
Yeah. These next two slides are centered around financial reporting. So this slide specifically is geared towards more think about stakeholder management. So if you do have managers or anyone that you do discuss company finances with or strategy and things like that, just understanding, a couple questions to just consider is, how often are key managers, field managers, things like that, kept up to date? And it could be just giving them enough information for their specific division that they're in, or it could be company-wide. Discussions of cash flow, what comfort level is with doing something like that. And then goal setting, so income statement and balance sheet goals, which we'll see in just a moment. A couple of income statement goals might be, revenue goals. It could be gross margin goals, net income goals, those kinds of things. And then the last bullet point here, as a company, if you are considering perhaps at some point having an exit in the future, there's going to be this acronym here, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, might be something to regularly review as time goes on.
That's a great point. Yeah, thinking about kind of the enterprise value too. That's being created.
And then so some of the balance sheet goals, from an accounts receivable standpoint, just looking at the collection period or the AR days, And what that's really referring to is how long does it take for us to get cash once we invoice a customer of ours. And then some other balance sheet type goals might be things like debt reduction goals or strategic growth. If we are taking on new debt, if we do pursue new financing this year, what is that going to do? What's our end goal? What are we trying to accomplish by doing so? Maybe you're refinancing your debt to lower rates, and so maybe there's opportunity to consolidate, if that makes sense. Having some sort of line of credit, so it could be an operating type of line of credit that's used more regularly. It also could be a line of credit just in case you need a little bit of a bump during a slow time. And then, as mentioned earlier, there are different types of ratios: current ratio, debt ratio, and those kinds of things. And then just really monitoring those goals throughout the year. Excuse me. And so if you have metrics and they, let's say, for example, in this example, it's a revenue goal. Let's say hypothetically there was $100,000 annual goal and you've met that by July, but then you take a bit deeper of a dive and you see that it's just one or two customers that made up the majority of that. Does that goalpost need to move forward a little bit more to really capture and true up, if you will, what the true revenue goal for this year should be, since we got a big lift from maybe a couple jobs. So
awesome. And just to kind of show you, those that are with Cycle CPA, this probably looks familiar. This is part of our Cyclescape reporting. But when it comes to the financial reporting, I think trying to find ways to really organize that data so that you can make managerial decisions based off of it, right? So in this example, you can see, you can clearly tell, even if this company decreased in revenue, they actually improved their total direct costs or cost of goods by around 4%, right? So went from 43% to 39% direct costs, right? So it can kind of give you that reassurance and, being able to track this over time as well. And you can look at it even within your overhead costs and really kind of dial down. You can see this company, their overhead was around 46%. And actually improved, but you can also see that their overhead salaries, that's really where they're a little bit heavy there, and I think where they have a lot of opportunity to improve, right? So it really comes down to, okay, taking the metrics, getting into KPIs and really the important things to focus on, and then really kind of trying to diagnose what we can improve on. And that goes whether you're looking at profitability, as Aaron said, even looking at EBITDA, something that companies use for evaluations, where they'll take that and add a specific multiple to it, or return on equity, right? And the liquidity, how well is the company keeping up with some of the short-term debt and liabilities of the company, and leverage. Like I said before, almost like how a bank would look at your company based on risk, and then assets when you're looking to make those kind of decisions, right? So, and that really concludes today's presentation. I know we're already a couple minutes past the hour here. I know we have some questions as well. But yeah, feel free to definitely ask away if you have any questions about what we covered or just in general on the accounting side. I know that there were some questions in regard to credit card transactions. So whether as an accounting firm, if we need those to actually categorize the transactions. So it's really receipts are needed more for cash purchases, or if there's service line tracking or job costing, stuff like that. But just for record keeping purposes, definitely keeping it on hand in case there's an audit for any receipts. But mostly, like I said, it's more just needed for some of those other things where you want to get a little bit more granular when it comes to receipt tracking.
All right.
Yeah, and I'm going to be sending this recording out to everyone as well, either tonight or first thing tomorrow morning. So everyone will get that as well.
Yeah, and we work with businesses all throughout the United States, all the way from Alaska to Florida. So, yeah, let us know if you have any questions. Feel free to email. But it was so nice getting to see everybody today. Super proud of you guys for sitting through an accounting presentation. But hey, this is something good you're doing for your business. So props to you. And I hope you have a nice rest of your evening here. Thank you, everybody.
All right. Have a good night, everybody. Thank you.
Good night.
Bye, everyone.